Hello and welcome to our Mines and Money 5 at 5 show. This week's episode is sponsored by Puregold Mining and brought to you in association with RGN Resource Global Network. For those of you attending 5 at 5 for the first time, the aim of 5 at 5, 5 guests at 5 p.m. is to maintain engagement between investors and miners through a lively interactive format during the current situation. A few admin announcements before we start. To make it as interactive as possible, please have your videos switched on. And to ask a question, you have two options. You can either submit them via the chat function, which is at the bottom of your screen, or even better, you can wave your hands via the invite participants function. I will unmute you and you can ask your question live. And being towards the end of the week, we encourage you to bring along a glass of wine or beer to go and relax, sit back and enjoy. We will also be having polling questions throughout the webinar where you can vote. So, without further ado, Elaine, can we perhaps bring up the first polling question of today's webinar? So the question that's coming up on your screen now is, even though I've been in the mining industry for 6 years now, I confess to only having read 4 books about mining and commodities. So the books on this list is a very, very biased choice. So the choices you've got is The Big Score, which is about the Voisey Bay discovery by Jackie McNish, Mining Unearthed, definitive book on how economic and political influences shape the global mining industry by Professor Philip Crowson of the University of Dundee, Brix, The Inside Story by Diane Francis. There are around about half a dozen books written on Brix. And last but by no means least, Turning Rocks into Profit by Julian Baring. And if you are selecting other, because I've got a very, very small and limited range of books I read, please post in the chat function which is your favorite book about mining and commodities. Whilst you're voting, let me just briefly introduce this week's guests. We've got a star-studded lineup of guests, including Darin, Labrenz, CEO of Puregold Mining, Dechev, CEO of Mundoro Capital, Ivan Bebek, CEO of Auryn Resources, Ed Meir, Senior Commodity Independent Consultant of ED&F and Man Capital Markets, and Chris Berry, President of House Mountain Partners. So perhaps, Elaine, we can close the poll and have the answers up. So it looks as if it was pretty even, but the most popular book on my list was Brix, The Inside Story. But a lot of you, 32%, wrote other, and so hopefully you're posting your answers in the chat room. Whilst I'm just reviewing those answers, perhaps I can go around and ask each of our individual panelists in turn, which is the most influential book on mining and commodities that they've read and why? Perhaps I can turn to yourself first, Darin.
Yeah, you know, I was going to embrace a book that I just started reading, which is Never Rest on Your Oars by Norman Keevil, which I haven't read it yet, but it seems to be a fascinating account of deal making, what happens in the background, and how serendipity plays into it. But that's cheating a bit because I haven't actually read it yet. So last book I read was The King of Oil, which is about Mark Rich. He was a big oil trader, and I found it just fascinating, you know, tied in, you know, his history, and it was almost like reading the nefarious side of trading, and felt a bit like a thriller at times. And of course, he went on to found Glencore as well. So just a fascinating read all the way through it.
Okay, perhaps can turn to yourself, Taya. What's your favorite book?
Oh, well, I don't read a lot of books. Don't really have a lot of time. I probably spend more time on audiobooks than I do actually reading them. But I think that for this space, and just in general, when it comes to biographies, I find that they're very edited, and I like to see actual real live interviews with the people. What I would actually recommend is if someone wants to kind of get a firsthand experience for exploration and discovery, to check out YouTube, David Lowell, who discovered Escondida. He's a fantastic explorationist and kind of one of the legends in our industry. So I would recommend just getting in front of YouTube and searching up his name. There's lots of great interviews. Another really good one is probably Richard Silito, Dick Silito. He's among the tech geeks in our business. He's kind of like the grandfather, the legend of porphyries. And he has a really, I think, generous way of describing what exploration really looks like from a scientific point of view. So if anyone has an interest in figuring out why discoveries happen and why they don't, I think you should listen to some of Dick's YouTube videos. He's very good. And then, of course, Brent Cook, who, I mean, many of you probably already know, and he's great for explaining the red flags about how to invest in the junior sector. So I think those three are really great conversationalists. They're great interviewers, and they're just great knowledge.
Thank you very much for that. I think that someone's posted in the chat box that one of their favorite books is Intrepid Explorer, the autobiography of the world's best mine finder by David Lowell. So it's obviously quite a few people are agreeing with your choices there, Teo. Perhaps turning to Ivan, what's your book that you would recommend to our audience?
Sure. I mean, my obvious one would be to pick The Big Score, because I do respect a lot of how that deposit was discovered and how hard it was to monetize it the way Friedland did. But the book that got me going in my career was a book called Buffettology. It's by Mary Buffett and David Clark, about Warren Buffett and being a contrarian investor. I entered the business at the peak of the dot-com era, and I had a fondness towards the mining sector. And then I put value and timing of investment, of what was not in the mining sector at the time as a forefront to try and get into things that I knew little about, but the market timing would solve that kind of performing for me. It led me to meeting Rick Rule, one of the more famous contrarians, and then taking on the path myself as not only an executive, but as an investor, and being a heavy contrarian investor along the way, which, is, we all know, is extremely painful in long bear market cycles. But even with our news today, we picked on an asset that was well below intrinsic value. And although, apples and watermelons, it still represents that theory of being a contrarian purchaser of something. So a very meaningful book that will save you a lot of time of trying to learn how the mining business really works. And it'll give you some good windows where you can buy things that haven't moved up a lot yet, or sectors that are out of flavor, and mining seems to go there a few times for a while.
Okay. Ed, what commodities or mining book would you recommend?
Well, thanks for that, Andrew. I would agree with Darin that, any of the Mark Rich books are fascinating. Having said that, one of the most interesting articles I read on Mark Rich was from the Wall Street Journal. It came out in the early 90s. I've tried to Google it. I can't find it anywhere, but it was so... it left such an impression on me that I'll never forget it. Basically, it just shows you how commodities, how trading is an art form. And what the article discussed was one trade that Mark Rich did, and I don't know all the manifestations, but I'll just give you the quick bullet points. He basically bought some sugar from Brazil. He shipped it to Ukraine, where the Ukrainians wanted to, had a contract. The vessel got there. They could not pay for the sugar. They told them, look, we can't pay, but we have some copper concentrates. We could barter it with you. So he took the copper concentrates. They worked out a deal. The concentrates were so dirty that they found out they can't treat it anywhere except by one smelter, which was in Mongolia. So they railed the concentrates to Mongolia. They converted it into cathodes. The cathodes they swapped into oil, and the oil they sold to Japan, and they got out of the trade, and they made money. This is all pre-internet days where you just have to put your head together and figure out how to trade. And to me, that was the pinnacle of trading.
Okay, and last but no means least, Chris, which book would you recommend to our listeners?
Yeah, I have a couple that come to mind. I don't know if they're mining specific, but a lot of the work that I do kind of blends mining and exploration and production with technology. And so, a book that I read not long ago that I think really resonated was called More from Less. It's written by a gentleman. He's a professor, I think at MIT maybe. His name is Andrew McAfee. And so his view is that as technology continues forward, it is going to necessitate, a higher quality of life, convergence of lifestyles between the East and West. But his view is that we can leverage technology to actually use less of a given material in a battery or something like that. And so we can all benefit. And so there are benefits with respect to recycling and other, I think, technological angles as well. And so it was really, really interesting, because I think a lot of times we think, geez, we're going to need, 500 times, more cobalt or 500 times more lithium or something like that. And, that's not necessarily the case, I think, when you really look at how technology continues to improve, and that necessarily means less of a given resource per unit. So that's a good one. Another good one is actually it's a collection of essays. It's a book called Capital Returns. Again, not mining specifically, I should say, but it's written by a fund called Marathon Asset Management, and the essays go from about 2002 to 2015, which really coincides with the commodity super cycle. And so there are a number of essays in there about not so much market timing, but how to spot bubbles, when to invest, when not to invest, and how that affects your return on your investment overall. So those are a couple, again, not really mining specific per se, but I think really resonate in the resource business for sure.
Okay, well, some really excellent selections there. I think there's plenty of ideas for me as to what books to go and buy when I go to Waterstones on Saturday looking for a good holiday read. So thank you very much for that to our panelists. And with that, we're going to have our first mining update of the show. Actually, all three projects today have gold as part of their asset portfolio. So let's bring up our second interactive poll, Elaine. And the question is going to be fairly unsurprisingly, where will the price of gold be by the end of 2020? 5 choices. US got 1600 to 1800, 1800 to 2000, 2000 to 2100, 2100 to 2200 per ounce, and above $2,200 per ounce. Whilst we're voting, let me ask our analysts for your support. For your thoughts, Ed. For people that don't know you, your track record on forecasting commodity prices is probably the best in the business. You obtained Metal Bulletin's #1 ranking as being the most accurate forecaster in LME metals for the past 8 years. What's your answer?
Well, gold is, it's one of those metals that anyone's guess is as good as anyone else's. So it's such a sort of a sentimental, psychological metal. But I think something around 2000 and up by the end of the year obviously looks reasonable to me, given the state we're in. Basically, we're just opening up the monetary spigots. Everyone is printing money, raising debt, throwing money at problems. And, this is all very bullish for gold, especially if it weakens the dollar, which is what I think it will do as well. So north from here, I think, into year end.
Chris, you've been an independent analyst since 2009. Where do you think gold is heading?
Yeah, I mean, it'll probably be at 2000 by Monday at this rate. Look, gold and silver really aren't my area of focus. I do a lot of work on macroeconomics though. And it's obviously going higher. I mean, I think, if you sit here in the United States and you look at GDP numbers, industrial production numbers, unemployment claims, clearly this is a very, sluggish problem, right? Sluggish economy. And it's clear that the Federal Reserve and the U.S. Congress are going to do whatever they can to try and shock the economy back to life. And they have chosen to use Ed's phrase, print with reckless abandon. So that's obviously has to be bullish for gold, and I think to a lesser extent silver, as it becomes a reality in terms of just how precarious a situation we're in right now. I would say that I think maybe just to take a contrarian view here, I'm not sure if inflation is necessarily around the corner. I think that, when you look at the amount of debt that we're shouldering here in the United States, the unemployment numbers, excess capacity, not just in the US, but all over the world, I actually think that the deflationary impulses are probably a little bit stronger right now. Again, what that means for gold in the near term, it could be range bound. It's hard to say. I mean, everything's on a run right now. I think ultimately inflation is the end game, but I think it's going to be a little bit of a bumpy ride. And I think that, you don't want to discount these deflationary impulses. The Federal Reserve certainly doesn't seem to be doing that.
Thank you very much for that. Perhaps we can have the polling answer up on the screen now, Elaine. And I think we can see the most popular answer was 2,000 to 2,100 US dollars per ounce. So without further ado, our first mining update is Darin, Labrenz, CEO of Puregold Mining. The Puregold Red Lake mine is Canada's next gold mine. Fully funded, the project is on track to deliver near gold production, near-term gold production into a rising Canadian gold price environment, with first gold production scheduled for late 2020. How would you have voted, Darin? And can you give us an update on Puregold mining?
Sure. Yeah, it's interesting. In my 30-year career, I've been focused almost entirely on exploring for gold, developing gold assets, operating gold mines, and I've always naturally thought of gold in U.S. dollars. And with our own Puregold mine on the cusp of production today, I've just now started thinking about it in Canadian dollars, and it's really quite remarkable. When you think about gold last in this level in 1,900 plus U.S. dollars per ounce in 2011, the Canadian dollar was on par with the U.S. dollar, and so they're both roughly equivalent at 1,900 plus. Today, we've got gold trading in Canadian dollars at $2,600 an ounce, which is really incredible. It's for our own projects, it's led to an incredible period of margin expansion, given that all of our costs are in Canadian dollars. So, having said all that, I think the drivers for gold are very much intact, and it certainly wouldn't surprise me to see gold in that 2,000 to 2,100 per ounce range by the end of this year. So shift across to Puregold. Our mine's located in Red Lake, Ontario, and I think I'll touch on 4 themes that I think really differentiate us. Location, of course, grade, size, and growth potential. I've already talked about gold price and how that drives the economics in Canada, but I think you could also talk about geological jurisdiction. And when you look at Red Lake, Ontario, it's home to 30 million ounces of some of the highest grade production in North America over the last 100 years. So we certainly think from a geologic perspective, the endowment potential of Red Lake is very strong. We are North America's next gold mine to come into production. Our first 1 million ounces will start pouring before Christmas this year. We are fully funded, and production, our mine will be the 5th highest grade mine in Canada and the 17th highest grade mine on the planet, which puts us in about the 95th percentile worldwide by grade. If we want to talk about size, we've very much taken a phased approach to what we believe is a scalable asset. Our 1 million ounce probable reserve at 9 grams per ton comes from a portion of our mineral resource, with 2.1 million ounces of indicated at 9 grams and 500,000 ounces of inferred resources at 8 grams per ton. We have several discoveries at surface, Fork Zone, Wedge Zone, Russet South Zone, which were not considered in the building of our phase 1 mine. And they span a 7-kilometer long mineralized corridor that's wide open for expansion. So I think growth is apparent from these recent discoveries. Despite being months away from production and cash flow, we've initiated an aggressive exploration program. We've got 30,000 meters of drilling that will occur between now and February of next year. And this work is really designed to realize our vision of growth at the Puregold mine. I think there's one other key element that really ties this all together, and that's people. Our team has a diverse, rich depth of experience in operating mines. I was chief geologist at the Campbell mine in mid-1990s and certainly have a rich knowledge of the Red Lake mining district. And collectively, across the board and senior management team, we have 6 individuals that really cut their teeth in the camp, about 135 years of collective mining experience. Across the team, we've had a key role in the operation of 68 unique mines. So I think that we're perfectly positioned to generate real value with the right people, the right asset, and the right timing.
Okay, well, thank you very much for that. Perhaps an opening question for me. I think you slightly touched on it in your presentation, but you've just recently announced good drilling results from the Red Lake project. What are your plans for expansion going into sort of rest of 2020 and 2021?
Yeah, so we've got, our drilling program really is designed to achieve three goals or 3 outcomes. One is, conversion of resources reserves, primarily in that phase 1 footprint. But again, given the approach that we've taken in building out a phased mine, we are looking to expand our near surface discoveries that lie outside the footprint of that phase 1 mine. We already have resources in those areas. We've done some early stage engineering. We released a PEA last year. And so I have an understanding of how they'd be mined, what the productivity would be, what the cost would be. So we're moving forward very aggressively in terms of determining what the ultimate size of those, what the size of the plant should be. And ultimately, we would look to layer those on top of the phase 1 mine through an expansion of the plant as early as year 3 of operations.
We've got a question from Joe Kukuza in the audience, and his question is, what is the expected mine life based on known resources?
Well, I'll answer that first with respect to our known reserves. So again, probable reserves of 1 million ounces at 9 grams per ton, and that turns into a 12-year mine life with the current plant size. But again, that comes from a broader 2.1 million ounce indicated resource and 500,000 ounces of inferred. we're certainly thinking about plant expansion and also looking at longevity of the mine. When you look at our asset, we've got resources that span a 7-kilometer strike length. We've defined them from surface down to about a kilometer depth, but we've intersected the deposit at 2 kilometers with about ½ ounce per ton returned over 2 meters. And so we certainly think there's strong potential for this, like other assets in the area, to continue to depth. In fact, when you look at the Red Lake mine that's located just 15 kilometers down the road from us, they're mining today at a depth of 2.5 kilometers below surface. And so we certainly think that we've got an asset that will be not just 12 years long, but a multi-generational asset.
Mm-hmm. Do you have any sort of like targets for what the all-in sustaining cost will be when you go into production?
Well, from the feasibility study, they're projected to be $787 per ounce, and it's really quite again, amazing to step back to the start of this conversation when we finished our feasibility study about a year and a half ago. We had strong margins and very robust economics at a $1,275 per ounce. Today at plus 1,900, we've seen incredible margin expansion. In fact, on a per ounce basis, you're looking at about $1,100 US margin with costs of $787 per ounce. So it's really a fantastic opportunity here. We think we're perfectly timed to bring our mine into production before Christmas this year.
I think when I checked at the weekend, your share price was, I think, 126p when I checked at the end of last week. Do you have a sort of like a target price in mind where you're hoping to be by the end of 2020?
Yeah, that's always a challenging question to answer. I guess I'll turn around and look at it a little bit differently. I think that we're seeing a natural move with the gold market. Again, we are going through a period of great margin expansion, and as the next mine to come on stream in North America, I think that we're well positioned to benefit from that. I think we're going through a natural re-rate here as we come into production, but it's a little bit unique in the sense that we are concurrently advancing our growth through a 30,000 meter drill program. So I think the way I look at it is you look at what our peers trading at. If you look at what is 100,000 ounces a year, what's it worth in the world today, and you can look at things like Wesdome, which is a $1.8 billion company. I think there's a lot of room for us to grow just as we come into production. And so the way I look at it is, effectively you're going to see a re-rate as we come into production, and all of that growth that we look at, the exploration that we continue on is really coming for free.
And I think the last one that I've got, I'm going to ask you, but then I'm also going to ask our other two miners as well. You recently received environmental compliance approval. How important is ESG to you and investors that you are speaking to?
Oh, it's extremely important. I think that we have a responsibility to operate mines in a sustainable fashion. And when I look at our own particular site, it is a brownfield site. There's historic production there of about 2.5 million ounces. And that occurred through a 36-year continuous operating period that started in the mid-1930s. And clearly practices back in the mid-1930s were not the same as they are today. So, I'm really proud of the efforts we've and our achievements over the last 4 years as we've progressively reclaimed the site as we come towards the cusp of production. And bear in mind, we've done all of this work without any cash flow. So we've turned a site into something that didn't look so great into something I'm extremely proud of today. And at the end of the day, our mine is designed for closure. Everything we've done has been done with the future vision of how we're going to close out the site. And it's really, again, a unique position in that not only are we going to design a mine for closure, but we're going to close out all those legacy issues as well from a historical mine. So it's it's a rare situation where your mining operation will improve the environment and bring it back to its original state.
And then just sort of bringing in Ivan. Ivan, how is Auryn Resources meeting the increasing ESG demands of investors?
Well, just in our case, we're primarily socially impacting. I mean, our technical team comes from Newmont. They're all global experts that ran, heads of departments in Newmont. And we've carried that same strict threshold that Newmont would carry. And we carry it early from day one. We generally take on projects with a seriousness that they could make it all the way to the mining state. We understand that's going to be critical, not just for the stakeholders, the neighboring communities, and the impact environmentally, but for long-term vision of our plan, which is to exit through a sale to a much larger entity, or in our Canadian portfolio to actually go build mines ourselves. So we've taken that really serious from day one. And as an exploration company with assets in Greenfield is something that we're very proud of. And it's been incredibly positive by reaction. It gives us a lot more comfort that we have something that will be worth a lot more. And, much to Darin's point, leave a a much cleaner footprint than maybe we started with. And in greenfields, it's a bit easier because you're starting clean, but not all projects are greenfields, and we just have to manage ourselves that way from the beginning.
And your self-tear?
I'm sorry?
Oh, that's a really good question. We're focused on exploration, so we generally do not look at the mining side, but basically what we do and what we find is really effective. You have to build community support. You can't do any part of this business without the communities being on side. So whether you're running a ground mag program or a drilling program or metallurgical studies, you need their support. One of the things that we pride ourselves in, and which is why I think we have the type of partners that we do, is that we start the process right when we get the license. We go in, we talk to mayors, we talk to communities, we ask them, what do you need? You know, what's important here in this community? And some communities come back and say, you know what, we really need some health related clinics, or we need more education for our young kids, or we need a nurse to come to the local hospital. So our approach is to go in right from the beginning, listen to what those communities want. And not every community wants the same thing. Some of them want very different things. And to try and align, you know, the amount of investment that we have available with what their most immediate needs are, build that trust, do it year after year after year. One of the best ways to build trust is when they come up to you and say, you know, my street is snowed in, and I see that you guys have a snowplow. Can you help me out? It's a lot of those little tiny steps that build so much credibility over a long period, which we find is, you know, the best way to build community support. So our programs, yeah, we've been very fortunate. We've got a really good program in Eastern Europe.
Okay, thank you for that. Let's now sort of like switch to tact, and I sort of come back to our two investor analysts. And I want to ask them about sort of trends they see happening in the next sort of 6 months in commodities and mining. Perhaps turning to Chris for the first, you've got to focus on energy metal supply chains, including lithium, cobalt, graphite, vanadium, and rare earths. What key trend do you see happening over the next sort of 6 months?
Well, you know, just to sort of echo the sentiments, I mean, every investor that I speak with now, whether or not it's hedge fund, pension fund, any you know, shape or size, ESG is really the first question out of their mouth. I also do a lot of work with groups along the lithium ion supply chain. So whether or not it's cathode manufacturers or OEMs, you know, burnishing those green credentials is really, really important. So I think ESG, and I guess trying to find ways to create a more circular economy or a circular mining process is really, really important to the downstream players now. I think that, you know, when you look at some of these commodities like lithium and like cobalt, I mean, obviously COVID and I think the trade war have sort of frozen everything in 2020. The major question that I sort of field now from everybody is, okay, so by 2025 or 2030, these markets are going to be a lot bigger because of EV and energy storage penetration. You know, when do we get back to these demand levels of 2019, where, for example, lithium demand was growing at 16% a year? And I think it's going to be a couple of years before we do that. That said, I see some very opportunistic groups further downstream, whether or not they're OEMs or, you know, larger funds, a lot of work in oil and gas, actually. They're really looking very closely at the lithium ion battery supply chain, because I think there is a realization that, you know, while oil use, at least probably in my lifetime, is never going to go away, it is a real threat and an opportunity to a lot of these oil and gas businesses. I mean, we've seen BP write off $18 billion in oil and gas assets. And there was somebody else this morning that just, I think it was Total, wrote off about 8 billion euros worth of assets. So, you know, I wouldn't let the low price of some of these battery commodities like lithium or like cobalt sort of fool you in terms of, and kind of make you think that, oh, geez, you know, the game's over, we missed it. We're really just getting started. I think that, again, beyond ESG, you know, when you look at what, I guess, presidential candidate Biden is talking about, he wants to invest, I should say, $4 billion is it $4 billion or $4 trillion US dollars over during his administration in green infrastructure. We're hearing similar things in South Korea, similar things in China. Of course, the European Union is running away with this whole theme. a lot of that has to do with the fines, the potential fines that automotive manufacturers are going to face starting next year, as high as 35 billion euros. So, look, we're really close, just on the EV side, we're really close to cost parity between an unsubsidized electric vehicle and a traditional internal combustion engine. That could come as soon as 2022 or 2023, depending upon a number of factors in the air, battery technology, things like that. But that is a reality, okay? And so we know that is happening. Now, on the energy storage side, it is a little bit of a different ball game. You have other technologies like vanadium redox and zinc air, all of which have their pros and cons. But right now, I think that, the market has kind of decided, based on scale, based on, a 30-year history of safety and of use, that lithium is the winner. And so, what does it mean for the mining space? I mean, lithium is an oligopoly. It's going to the market will triple in size, in my opinion, by the late 2020s. So if we're at 300,000 tons a year today, we'll be at 1 million tons by 2027, 2028. The major players will, ramp their capacity to the extent possible, but there is room for more players that are not current producers right now. So, the name of the game, I think, is finding the right partners, because this is a very technical business, and also lining up those offtakes. So look, it's quiet right now. In 2016, 2017, this business was a lot of fun because prices were going crazy. Everybody got excited. And, look, I mean, you can say what you want about lithium and cobalt, and are they commodities or specialty chemicals? A lot of people think they're specialty chemicals because of the amount of effort that it takes to produce them. And as such, they deserve a higher premium, but they're behaving like commodities just in terms of the pricing. And so, what I think a lot of the lithium near-term producers are doing right now is just positioning, not necessarily growing the asset, but proving to the market, whether or not it's oil and gas players, whether or not it's OEMs, that they can actually produce battery quality material at scale. And that's why I think the next pinch in this business in particular will probably be 2022 or 2023, when, again, the EU and of course the Chinese have really pushed forward on EV adoption. And you have a number of more models out there, and we're going to realize that there just is not enough lithium or cobalt probably ready. So a couple more years, but I wouldn't let the low pricing environment right now sort of fool you.
Okay, thank you for that. And Ed, which commodity trend would you like to pick?
We focus really mainly just about a year out, because our visibility beyond that is hampered, I think, by a lot of factors. But I think for the next year, the next 6 months, for all the LME metals that we follow, we think we'll have a slightly higher trading range over the second half of the month versus the first half. We think the lows were put in pretty much for copper, aluminum, zinc. China is driving demand for all these metals. They've been the only economy to kind of recover nicely. A lot of it is internal use that's driving it. Our clients are telling us that factories, commerce, it's all cranking up very nicely in China. Traffic is back to its old levels, pollution, all the kind of the key indicators that people watch. The only negative, or I should say the only question mark in the Chinese story, is how robustly can they grow when all their trading partners are in recession, because they are still dependent on exports to some degree. So when Japan and Europe and the US are in recession, that's going to knock their exports a bit. But having said that, we think the low level of stocks, the difficulty of finding new deposits, you can see what's going on with the miners, labor getting more, I should say, more radicalized in terms of their demands. Governments want more of the pie. It just is getting harder to be a miner these days, and it's getting harder and more expensive to produce a host of these other commodities. So once we are over this demand slump, which I think will start to peter out by early next year, depending on how a vaccine comes along, and a big if is what happens with the US election, because I think we could veer off in completely different directions with a big impact on commodity markets depending on who wins. I think given all these assumptions, I think we will be in a much more positive environment going into next year for a number of metals.
Okay, thank you very much for that. So let's move on to our second mining update, who is Dechev, CEO of Mundoro Capital. Teo has diverse experience in the mineral sector, which is uniquely positioned to bring value to Mundoro Capital. Mundoro Capital is focused on investment in gold and copper. So without further ado, over to you, Teo.
Great, thank you. And it's actually great to have that commodity update before this, because, you know, a big part of what Mundoro does is really look for those what we call future mines. You know, like I said earlier, we're not in the business to become a miner. There's plenty of very good miners, but not all of them are geared and ready, even the big ones, for exploration. And there's a number of factors that go into that, which I'm happy to talk about in the Q&A. But basically what we're focused on is discovery. We believe that the discovery creates the best value creation in our business. And how we do that is basically this. We find mineral camps that are currently being underexplored. We establish land packages along the main trends in those camps. We build exploration models and teams around the projects. So we don't just, you know, bring a team around everywhere. We really do believe in the idea that you must have local experience, and we do complement that with international consultants. And then we bring in those deep-pocketed partners. And this is the really important part of our business. Mining has become fundamentally very different in the last 20 years. It was back in the heydays in the 80s and early 90s when you could make a discovery and get it into production. Those are becoming much more scarce opportunities. They become scarce because of the specific type of assets that are getting basically put into production. But our focus is large-scale systems. They create the biggest value for shareholders, and if you're going to take exploration risk, you've got to go big. So the type of partners that we end up attracting are groups like Vale, which is currently our partner, you know, the world's third largest gold mining company. Freeport, world's largest copper producer. JOGMEC is the Japanese government. Essentially, they created a fund to go globally and search for copper and base metal assets. First Quantum Minerals is also well known in the industry, and then there's a few other players that are from Eastern Europe. So what's really key in the business is to put yourself in a position where you can maximize and leverage existing data. We think that the Tethyan Belt, specifically the western portion, which falls onto Eastern Europe, is phenomenally underexplored. This is basically what we compare to as the Maricunga Belt back in the 1980s. You know, with more investment dollars, you will see more discoveries in this district. The metallogenic maps are fantastic. The geology is great. There is a real propensity and history for mining. You know, for example, where we've landed is Serbia and Bulgaria. Serbia, you guys will probably know because of the Čukaru deposit, which is a fantastic discovery in our industry, you know, 2 billion tons with this, you know, phenomenal high sulfidation zone at the top that just makes the economics. It sold for $1.4 billion to Zijing because Nefson obviously got taken out. But it's an example of what is available and what is in store for this region. But really what Serbia should be known for is its bore system. So the bore mines are 100 years of mining. So there's 4 billion tons of porphyries here. This is why every single major base metal company in the world is looking in Eastern Europe. So what we've done is, you know, we recognize that potential. We recognize that there was a lot of discovery still to be made. Nobody was there. People had this total misconception of, well, you know, it's Eastern Europe, it's filled with criminals. Well, I'm sure that we can point to many jurisdictions in the world, even some of our backyards, where there are, you know, it's an imperfect system everywhere. And what you really need to do is find out what's the potential, what's the risk, is it manageable, and who's prepared to invest. So we've done that in Serbia and Bulgaria. Our portfolio is really one of the best in the region, and it's because, frankly, we got there before anybody else. And what we have lined up for this year is we've got our program going with Vale. So we are currently starting out in the field with the idea to be drill testing by the end of the year. We are also in discussions with bringing on board another partner for another project in Eastern Europe. And again, like the copper market is, what's fascinating is the difference in how a base metal company sees the copper market versus what an investor sees. The copper miners there was absolutely no blip in their appetite for more copper assets, even though as the copper price was going down. So I think it's just a testament that we definitely need more copper mines, and these groups are serious in throwing, tens of hundreds of millions of dollars into exploration. And the last thing is, we also look for opportunities where there are old mines that have been shut down by the Soviets. Those are great opportunities. Those are much more difficult to get, but we found a few. So JOGMEC, thank goodness, is a very forward-thinking partner, and they've aligned with us for 3 copper deposits in Bulgaria that we've put in applications for. So we think those are going to be phenomenal opportunities for the company. We've also got an old mine that is a copper gold high sulfidation system. It looks a lot like Chelopech, which some of you may be familiar with, which is Dundee's main asset in Bulgaria. That's a really interesting one. In Canada, if we come across 6 million tons of 1% copper and 3 grams per ton gold, we're all going to stand up in attention. But in Eastern Europe, it's phenomenal with these assets, which you can pick them up for. So essentially, we put in a bid for $1 million for that asset, and we hope to be able to sign that with the government this year. So we've got, I think, really good catalysts, really good partners. I think there's a lot of exploration potential, and when we're trading at 15 to 20 cents, it's we think it's a no-brainer to double, triple our value, and I think that will be reflected over the next 12 months as we show our results.
Okay. A couple of questions. Why is Mundoro's asset portfolio located in Serbia and Bulgaria? And do you have any plans for expansion beyond that?
Well, Serbia and Bulgaria have made the most progress in their mineral laws. One of the first things that I do when I go to a country is I talk to everybody that's there. Whoever's operating, I talk to them, whether it's a driller, a miner, a consultant, all the embassies, talk to the Australians, the Americans, the Canadians. They all have a little bit of a different view on what risk is. And it's very clear that those 2 jurisdictions have made the most progress beyond, a government or a minister saying, please come and invest in my country. It's actually changed the law, made it conducive for foreign investment, and foreigners are operating assets. So those 2 countries, we think, have made the most progress. So that's why we're focused on those 2. And certainly the upper Cretaceous portion of the belt is the richest portion of the belt. So if, in the exploration business, you go where the metal tells you to go, and that's the upper Cretaceous portion. And on that particular portion of the belt, there's a really good 1,000-kilometer stretch that basically overlays those 2 countries. So which is why we're there as well.
Question from Jacob Ambrose Wilson of Resource Global Network. What is the exploration permitting processes like in Bulgaria and Serbia?
The licenses?
Sorry, what is the exploration permitting processes like in Bulgaria and Serbia?
So they're a little bit different, but the timeframes are generally the same. So in Serbia, you apply for an exploration license, and then you essentially have about an 8-year term in order to file a commercial discovery, which is basically a resource assessment. And then from there, you can apply for an exploitation license. It's very similar in Bulgaria, except that in Bulgaria, you actually sign a contract with the government. And this is something that also ties into, ESG, what we were talking about a little bit earlier. In Bulgaria, you're actually making a commitment to the Bulgarian government about what you're going to be spending on environmental and social practices. So for example, about 10% of our commitment in the country is always for investing in local communities. And it actually puts everybody on a really good platform, because now when you're talking to communities, they know exactly up front what you can commit to, how much you can spend, and what the time frame is. And it's mandated by the government. So I think it actually creates a really good ESG opportunity in that country.
Okay, and a question here from Frank Pretorius. How stable is the power supply to the exploration sites, and what percentage of the exploration cost is energy provision related?
Oh, that's a fantastic question. And this would be the opportunity to show that slide, but I know we're not going to do that. Eastern Europe is Europe. So there are roads everywhere. There are power lines everywhere. Bulgaria actually has excess nuclear capacity. They've actually been asked to shut down one of their plants. There is very good rail. And in Serbia, there is direct gas lines that come in from the east. They have more gas energy than they can actually consume themselves. So the power situation is extremely good. And that is actually an extremely important point for all of those big partners that I brought up earlier. They want to be in jurisdictions where they don't have to have 1/3 or 1/4 of their CapEx going into the ground to just get to site. They want it actually to build mines. And that's a huge advantage in Eastern Europe. The infrastructure is all there.
Okay, thank you very much for that. I think in the interest of time, we're going to need to move on to our third and final mining update, which is from Bebek, CEO of Auryn Resources. Mr. Bebek was formerly the president, CEO, and co-founder of Caden Resources, which was sold to Agnico Eagle Mines for $205 million in November 2014. He was also a co-founder of Keegan Resources, which is now, of course, Asanko Gold, and he is a co-founder, co-chairman, and director of Thake Resources. Ivan, why should we be investing in Auryn Resources? Over to you.
All right. Well, I'll start off as I'm a large investor, and the two successes you mentioned led us to taking on something different, kind of outside the lines. And we went out and raised $100 million in the last 4.5 years. And for those of you who can look past the last few months of the market performing, these were very challenging times. We've bought a lot as insiders, and we took on a feat to go find some of the world's largest mines. We call these tier 1 potential discoveries. And we classified that as mines that would fall into the top 20 mines on the planet. We've identified 3 flagships in Canada, where we spent the most money, something called Kuribaya. We spent $60 million trying to perfect the science of a 300-kilometer gold belt that we own from one end to the other with high grade everywhere. The guys that have done it are all former Newmont Global experts, and these guys have done a remarkable job of developing a strong skill set. And we acquired that. The gold market was $1,200, $1,300 an ounce. We were able to fund it and generate our today's market cap at those prices of gold. We're much closer to the discovery there. But as we were up north, we thought to balance out seasonality and go south. And of course, size being the biggest appeal, for the many reasons that Tio just explained at the beginning of her talk, and to what Mr. Darin was saying earlier, we went down to a belt called the Andahuaylas-Yari belt. And this belt has 4 or 5 of the largest mines in Peru, the 10th largest mine in the world, copper mine, being Las Bambas. And what was missed there was every major mining company was here. They felt the volcanic cover was a younger age event, and they did not look on the western half in detail. We did, and we found it's the same event, same intrusions that occurred that created those major deposits. And now we have hundreds of meters of copper and gold on the surface that's the same grade as Las Bambas, and in scale comparable to Las Bambas as well. But there's other targets that have been coming up from it. So a tier 1 swing in Peru, and one of the most prolific copper belts out there. And we have the other half of the belt, not another property on the belt, the other half of the belt. So we think we'll have 3 or 4 shots at those kind of tier 1 discoveries. We have a third project called Kuribaya. It's been littered with multi-kilo silver over a 4 square kilometer area. We don't know enough about this yet, except for it sits on the coastal belt with the big mines like Serra Verde, Quellaveco. We're first movers here. Nobody's ever drilled it. The grades are spectacular, and there's more coming to that Kuribaya asset. So today, or last night, we announced that we're going to split our company into 3. We're going to give shareholders 1 share for the Sombrero asset that I just mentioned, 1 share for Kuribaya, and then for Commodities and another project we have where we just announced a PEA on, which was a mine at 1350, or gave us the green light to go and spend more money on and grow that mine. We completed a merger. We're attempting a merger with a company called East Main Resources, which is based out of Quebec. Commodities, Homestake, and Eau Claire, which is the East Main Resources deposit, will form a Canadian exploration and development company. It's going to have huge upside potential in Canada, up at Commodities, and then it has a very development-oriented asset in Quebec that's averaging 6 grams, or about 1 million ounces mineable roughly to start. That was an opportunity that fell way below the value curve. They lost their VP of exploration about 6 months ago, and they had have an interim CEO. So it was a company that kind of had a great start about a decade ago, fell into the bear market. We showed up, and we have solidified that opportunity by bringing in a new CEO to run that organization by the name of Michael Timmins. Michael Timmins, for those of you who don't know him, he was the VP of corporate development for Agnico Eagle. We met him during the purchase of Agnico of Caden, and dreamed that one day we could work with him and build a company with him because of his skill set was so obvious, and his ambition and drive and know-how and pedigree was impeccable compared to, you know, something we don't offer, which is mainly exploration. So we've changed the mold considerably. Auryn today, if you buy a share of Auryn today, you're going to get the Canadian Exploration Development Company run by an executive that formerly was the VP of Corporate Development for Agnico Eagle. He's got experience in Nunavut, where Commodities is, as well as in Quebec with the purchase of Osisko on his track records, and he's built mines before. On the Peruvian side, those 2 shares will be full shares shareholders get. People are going to receive those by the end of the year when the deal closes. They will be unlisted for a short period of time, but as they come back to trade, they will be drill permits in hand, ready to go make another Los Bambas discovery in one of them. And we still don't know enough about how prosperous the high-grade silver and gold can be in the other. So you get 3 shares out of 1 share. Company trades at around a $300 million Canadian market valuation today. And that's largely premised off of the scale of opportunities, the maturity of the 100 million that we've spent to bring them to the forefront of discovery, and the quality of management that has, you know, the capabilities led by vision, you know, to go after the big, huge swing that makes everyone all the money, as well as the monetization ability to actually monetize the event that we make. And most importantly, the execution ability, where we can actually take a discovery from A to Z now with the current management team. So, you know, in a snapshot, we did 2 spincos and an acquisition in the same afternoon. 45 days of my life has been lost to making that transaction happen, but it's a very, very big outcome for us, and planned very intelligently with the start of this bull market, so that there's tremendous access to capital, and there's going to be potentially huge monetization events should we make those discoveries. And, you know, we are large shareholders. We build this company with shareholders in mind, and our best report card is not how great we are, it's how great our share prices are. And that's how we've really driven our business plan. And it's been a long wait for some investors, including myself, but it's more than worthwhile, as all the best parts of the equation have come together on the same day. So that's where we're at. That's what we just announced today.
Yeah. So kind of like just on that, I think that your share price has risen from, I think, 171 to 303 Canadian dollars over the last sort of 6 months. So you're going to presumably say to investors that they haven't missed the boat and that the best is still to come?
Absolutely. I mean, the most value, and that's a good return. It's not bad. It's not why we're doing this. The most value from us is going to come from the drill bit. So the drill in Canada, we're going to start a 50,000 meter drill program with a month of the deal closing on the Canadian asset at Eau Claire. And that's all to find more gold and add to the million ounces of 6 grams per ton. We're going to follow that Canadian company with another 50,000 meters roughly of drilling in 2021 that will go across Homestake and Committee Bay, again, to find more gold in the rising gold market. We'll use that currency to buy other assets and to potentially grow another Goldcorp or Agnico Eagle style company by the end of the bull market. So I'd say you're still before the first inning. You're going to get 3 shares for the price of 1 in that case. In Peru, we've spent 2 years, over $1 million with social and community engagements without a permit. We do not have a drill permit in Peru, so we committed really hard to make sure that our social presence was, to the points earlier, really well received, to the point where the government has given us an award for the agricultural programs we've done. You know, in Peru, we've made an action before words, and that was something that we learned in the last bull market. People went down to Peru with money trying to buy their way through permits. We did it the hard way, the long way. We've had interest from almost every major base metal company in the world on our Sombrero project. And so for investors, the fun part, the part where you're going to start realizing those gains that we've designed this company to deliver, it's going to happen starting in Q1 of next year in Peru and end of Q4 of this year in Canada. So it is the first inning. It is very early for us, and look forward to drilling to really make that equation all worthwhile for all of us.
Question from the audience. Can you just explain what is your principal reasons for splitting the company into 3? Would it have been an option if the gold price wasn't as high as it is now?
Great question. Number one, too many good things in one company. There's no way to get paid for more than one flagship asset in one company at a time, especially when you have different commodities. So we have high-grade gold in Canada, we have copper at Sombrero, and we have silver at Kuribaya. So that was the first reason why we decided that there's enough conviction on each of these independently. There's availability of high-quality management to split this into three and to take advantage of unlocking the value that we think is missing from our current share price. The second part of the question is, would we have done this? I've talked about it publicly for the last 18 months. People got sick of me probably saying it, but I've underpinned that initial suggestion from management corporately to be in a market where access of capital and performing share prices is as strong as it is today. So we would not have done this a year ago. It would have been very difficult and very dilutive. And as large shareholders, we're very anti-dilutive. And so we did this, and I have to compliment the team and everybody involved. The share prices perform beautifully. We get a very good premium on the quality of what we have by opportunity. And we use that to grow at the right, most optimal time, where it's not too late and we can't buy something like Eastmain for the price we're potentially getting it at. But at the same time, where we can raise a lot of capital at much better share prices going forward and attract the right investors. So the strategy was well planned from the start, and it was waiting for the market to be the final answer, as well as the addition of Michael Timmins. So that's why we chose this timing. And yes, it does unlock value across each asset.
And back to squeezing another question from the audience. Your way forward seems very well founded, but do you see any issues with funding one or more of the spin outs, or will each live or die on their own exploration successes?
So in terms of our shareholder registry, outside of ourselves, who've participated in pretty much every funding we've done, we have shareholders such as Ross Beatty, a gentleman by the name of Rob Sally, a Swiss broker that is, very capable, independent of going to the street and institutions. We raised the last $25 million between this March and last March ourselves. We did not go to the street for it. So financial raising capabilities are outstanding. The company, when it splits, is going to need money for Canada. We figured it's best to finance a high-grade Canadian gold company with investors that want to be part of a high-grade Canadian robust gold story. So we're going to do a subscription receipt financing with the deal, likely be done in the next week or two, but definitely before the info circular goes out. We have demand for the entire placement from two different parties. So that's double what we're looking to raise. And so right now we're going to look to strategize and align ourselves with the best shareholders to drive value forward with that business plan. On the Peruvian side, $7.5 million of Orange Treasury will be net of the deal, will remain in Peru as unlisted companies. That's $5 million for Sombrero and $2.5 million that will sit in Kuribaya. As options will likely get exercised, expiring, they don't roll over to Peru, they only roll over to Canada. Any options exercised between now and October, those funds will go towards Peru as well. Should Peru need any more capital before it relists, and we don't get enough money incoming from options, we would do a rights offering to existing shareholders who have qualified earlier, and then we would come back listed with pretty strong treasuries. Now, there's a good mention. I think Tio was doing a great job of talking about financial partners and different, people to partner with on the corporate side. Goldcorp Newmont, or Newmont now, owns about 11% of Auryn, about 11 million shares. And they may or may not stay. They have their own business plan. They were somewhat public about it at BMO earlier this year. But I mentioned earlier that several majors have expressed interest in Sombrero and some of the other assets, primarily Sombrero. So for us, in the sake of financing, we would like to come out, back trading a few weeks before drilling and go to a competitive negotiation for the best partner from the corporate side, limit them to a percentage that still allows others to come and bid and participate, but fund the company for 2 or 3 years of aggressive drilling in that huge district down in Sombrero. So we will apply a tremendous amount of strategy to best finance ourselves at great premiums. And by report card, the last time I've talked about doing something like this, we were trading at $2.95 a share Canadian, and we raised $36 million with Goldcorp at $3.67 per share back in 2017. And that was because of the scale that Commodities offered our portfolio. Well, now we have that in more places, and copper gold like Sombrero, you can walk and touch the copper and gold for 12 kilometers over our first 2 of several targets. I mean, that's a lot lower risk, a lot higher probability. So there's no question that we're going to need capital, but we have many sources to go and get it.
Okay, thank you for that. I'd like to bring in Ed here. The last two projects, both Auryn Resources and Mundoro Capital, have had copper obviously in their deposits. What's your outlook on copper and copper prices for the next year?
The next year, I think right now we're trading at around 6,500 basis the LME. I think over the balance of 2020, we should be trading between 5,800 to 6,800. And next year, if my assumptions prove correct, we'll probably trade somewhere between 6,000 to 7,000. So I think it's sort of on a gentle slope higher over the next 18 months. Again, depending on specific things happening with the U.S. election, with the Chinese economy, with the trade negotiations, which have basically frozen global trans-border investment. It's basically collapsed. We need all of these things to start rejuvenating again, because if we get a situation which we had in 2015 to 2018, we saw the global economy across the board, across industrial production metrics, everybody was expanding at the same time, and metals demand was at its strongest. So we really need the tailwind of metals prices, of demand to start elevating these metals prices. And we're not seeing it in this environment right now, but I'm hopeful we will over the next year.
And there's a question for Chris. Given Ivan's track record, when you look at mining companies and when you look at mining companies as with your like analyst hat on, do you look at the deposit first or do you look at the management team?
Always look at the management team. I think you want to find that optimal blend of experience, both from a technical perspective and a financial perspective. I mean, you know, a team that knows how to drill and how to build out a deposit, and also has the same level of expertise that knows how to go out and raise money and do deals that are accretive to shareholders. And of course, you know, skin in the game is absolutely vital. You know, most investors I know will not look at a company where management does not own, you know, a significant piece of the float. So, you know, the asset, we all know on this call, right? I mean, we've seen good management teams take marginal assets and make them into something. We've seen terrible management teams take world-class assets and destroy them. So, you know, I guess my view is that regardless of the commodity, copper, gold, lithium, rare earths, I mean, you've got to have a management team that has that blend of technical and financial experience and expertise. It's vital.
Okay, thank you very much for that, Chris. I think we're actually out of time, so that's been a really great program today. So I'd just like to go and thank our guests. I'd like to thank Chris Berry, I'd like to thank Darin Labrenz, I'd like to thank Ivan Bebek, I'd like to thank Dechev and Ed Meir. I'd like to thank our sponsors, Puregold Mining and also Resource Global Network. Our next 5 at 5 show will be at 5 p.m. Frankfurt time on Thursday, the 6th of August. Until then, stay safe. Thank you very much.
Yep.